topic, accounting ratio. Ratio can be defined as the relationship that exists between two figures. Accounting ratios are used in interpretation of financial statements. Ratios are considered in the following categories. 1, we have the profitability ratio. It measures profit earned over a period and capital employed at the end of the year. It includes the following example. A, we have the gross profit percentage. The gross profit percentage can be obtained using this formula, that is gross profit divided by sales, which at times can be referred to as turnover times 100/1. 2, you have the net profit percentage, which is also obtained by dividing the net profit by the sales times 100/1. And lastly, under this category, we have the turnover ratio. Turnover ratio can also be calculated by dividing sales divided by capital employed. Number 2 categories under the accounting ratio is the liquidity ratio. The liquidity ratio measures the extent to which business can meet its short-term obligation in terms of loan acquired or credit facility. If I obtain a loan or a credit facility for a specific period of time and is not properly utilized, it will definitely have side effect on the business. Then under the liquidity ratio, we have the following categories. 1, you have the working capital or the current ratio, or we can also call it the current asset ratio. But this can be obtained by dividing the current asset by the current liability. Then B2 rather, we have the liquidity ratio or the acid test ratio. This can be obtained by having this formula. CA stands for the current asset minus the closing stock. That is the value of goods left unsold at the end of the accounting period, and divided by the current liability. A very good example of current liability is the creditor. So when we go through this procedure, we at the end of the day obtain either the liquidity ratio or the acid test ratio. And thirdly, you have the markup. Markup is defined as the relationship between gross profit and cost price. Cost price can be described in other 2 ways, such as cost of goods sold or cost of goods manufactured during the accounting period. To obtain our markup, we divide the gross profit by the cost of goods sold and multiply by 100. Then fourthly, we have the margin. Margin is profit, that is the gross profit expressed as a percentage of selling price. Margin is also obtained by dividing the gross profit by the selling price times 100/1. And lastly, we have the rate of turnover or stock turn. This is the number of times stock is turned over within the accounting period. What do I mean by over within the accounting period? That is, it exchanges into what liquidity form, in form of what? Cash. To obtain our rate of stock turn, we have the following formula: cost of goods sold or cost price, and I call it cost of goods sold or cost price, divided by the average stock. To obtain our average stock, we simply add the opening stock plus the closing stock and divide by 2. That will give us the value of our average stock. At the end of the calculation, our answer must take the shape of times. That is, if for instance we have 1.2 at the end of the day, we must include times there. The times there indicates that stock actually exchange hands during the accounting period in 1.2 times. This is the end of the accounting ratio.